Hello everyone, John A.G. here. Exactly what happened is this. The U.S. Justice Department just hit the Federal Reserve with grand jury subpoenas, floating the idea of criminal charges, and the Fed chair fired back in public. That single move lit a fuse under global confidence, and you can see it in one place first. Gold and silver prices are ripping higher as 2026 opens. And if you're thinking, okay John, is this just another headline storm? Stay with me. Because when the people who control interest rates start talking like they're under legal siege, markets don't shrug. They reposition. Quietly at first, and then all at once. Now, quick favor before we go deeper. I'm running a campaign to push back against copycat channels that recycle other people's work and drown out original research. If you actually get value from what I do here, hit subscribe and drop OG John AG in the comments. It takes 2 seconds and it tells the algorithm who's really here for the real thing. Also, I've built a WhatsApp channel for daily updates, short posts, and my personal takes that I don't always put on YouTube, including instant voice notes when something breaks. The link is in the description. Join it because the market doesn't wait for uploads. All right, let's make sense of the week because it didn't start with a chart. It started with a warning shot. A Fed chair steps up, says the DOJ served subpoenas, and frames it as pressure tied to interest rate decisions. Not just paperwork, not just buildings, not just a renovation project. That's the story that hit the screen. And whether you love the Fed, hate the Fed, or think the whole system is a cardboard stage set, the implication is the same. If markets begin to believe monetary policy can be bullied, then risk-free stops feeling risk-free. Bonds wobble, the dollar narrative cracks, and hard assets get louder. That's why, 2 weeks into 2026, metals are acting like they smelled smoke before the crowd did. Gold doesn't move like this because a random analyst got excited. Silver doesn't stretch like this because social media got loud. This kind of move happens when trust starts leaking out of institutions, and people don't want to be the last ones holding paper promises. And here's the part most people miss. This isn't a sprint, it's a marathon, and we've already been running it for years. The last few years simply made it visible enough that normal investors finally noticed. So today I want to do 3 things in the same order every smart investor should do them. First, we're going to connect the headline, subpoenas, Fed pressure, political heat, to the real-world effects in pricing. Second, we'll walk through what gold and silver are doing right now, why the move matters, and what signals suggest it's not done. Third, I'll show you the hidden scoreboard, how fast fiat currency units are losing buying power against metals across the world, not just in one country, not just in one exchange, but everywhere. And yes, I'm going to leave you with the 2 questions everyone should be asking before the next leg of this trade hits. But before we get there, let me slip something in that many of you asked for. If you enjoy silver-related success stories, not theory, not doom, but real examples of people who positioned early and made serious money, there's a separate channel linked in the description. Subscribe over there too, because it's motivating to see what's possible when you stop being late to every trend. Now let's go back to the moment this week turned. A public statement, a legal threat, a central bank caught in a spotlight it never asked for. And then, almost instantly, the metal market responded like it understood the assignment. Gold came out swinging in early 2026, the way it did in early 2025, but with even more urgency. Silver, the white metal that everyone ignores until it humiliates them, kept doing what it did last year: outperform, overdeliver, and force people to rewrite their assumptions. And the key detail here isn't up or down. The key detail is distance from normal. These prices aren't just higher, they're multiple standard deviations above long-term behavior. That's the market screaming, something is changing, while the average person is still arguing about whether anything is happening. Now, in the middle of all this, TV analysts rolled out the familiar script. This is too much, too fast. It's a blow-off. Expect a pullback. Don't get greedy. And sure, any market can pull back. That's not a prophecy. That's gravity. But what I want you to focus on is something else. When multiple voices start calling it once in a generation, they're accidentally telling you the truth. Because you don't get monetary regime shifts every year. You don't get trust crises on a schedule. And you don't get a global scramble for real assets while everyone still pretends the old rules apply. That's why you're seeing language like secular trade show up more and more, meaning a long-term shift, not a weekend spike. And it's not just gold. Copper is strong, platinum is moving, palladium is still relevant. Silver is acting like it has a scoreboard nobody wants to read out loud. And the reason isn't magic. It's supply, it's utility, and it's politics. The world is waking up to a brutal reality. Critical metals aren't optional, and you can't print them. Governments can posture, corporations can promise, and central banks can talk, but none of them can build a mine overnight. That's a supply-side trap, and it takes years to unwind. Now, I'm not here to fact check every quote or argue about motives. You told me not to. What I am here to do is translate what's happening into what matters for you: positioning. Because while the headlines fight, the flows move. Let's talk silver first, because it's the most misunderstood. Silver isn't just a poor man's gold. That phrase is lazy. Silver is a hybrid, monetary metal plus industrial workhorse. Gold doesn't get burned up in factories the way silver does. Gold gets stored. Silver gets used, consumed, scattered into products, and often never fully recovered. So when you combine investor demand with industrial demand, you get a setup that can reprice violently. Now layer on top of that something people keep whispering about: multi-year supply deficits. A deficit isn't a bad quarter. A deficit is the market slowly running out of wiggle room. It's like draining a reservoir while pretending rain is guaranteed. Eventually, the faucet doesn't just slow down, it sputters. And that's when price stops negotiating politely. This is why, when you see silver flirting with psychological levels, like the triple-digit door, you should understand what's really happening. It's not just a number on a screen, it's a statement. Your currency buys less metal than it used to. And when that statement becomes obvious, it changes behavior. People who never cared start caring. People who mocked start asking questions. People who delayed start panic buying. And the worst part? They do it at the top of the first move, not the beginning of the trend. Now, let's zoom out to the global picture, because one of the strangest features of this bull market is that it's not uniform. Different regions are seeing different prices, different premiums, and different shortages. Premiums are the loudest signal the physical market gives you. When premiums rise, it means someone is paying more than the paper price to get real metal in hand. And that gap between paper and physical, that's where stress shows up first. Before we move on, I want to ground this in the kind of weekly numbers people overlook when emotions are running hot. Because here's what happened in plain English. Prices didn't just drift. They surged, held, and closed strong. Silver finished the week around the low 90s per ounce, and gold settled in the mid $4,500. Those aren't just big figures. They are statements about what a currency can no longer do. When you have to hand over nearly a full $100 bill for a single ounce of silver, the metal isn't expensive. The money is small. And the gold to silver ratio? It tightened. We're talking roughly the low 50s ounces of silver to buy 1 ounce of gold. And at points, it dipped even lower intraday. That's the kind of compression you see when silver starts acting like it's finally being repriced for scarcity and utility, not just sentiment. Now, if you're new, that ratio matters because it's the tug of war between pure monetary fear and monetary fear plus industrial reality. Gold usually leads during the first wave of distrust. Silver often leads when the move broadens and the real economy starts fighting over supply. So when you see the ratio sliding, don't treat it like trivia. Treat it like the market whispering, "This trade is spreading." And here comes the global twist. While people in the US debate whether $100 silver is real, parts of the world have already seen triple-digit pricing in local markets after premiums are added. Not because the metal is different there, but because the physical metal is harder to get there, or the local currency is losing purchasing power faster, or both. In particular, the Chinese physical market has been flashing something you can't ignore: on and off bursts of double-digit percentage premiums over the conventional spot reference. When a major market is willing to pay 8%, 10%, sometimes more, that is the physical world calling the paper world's bluff. And here's the part that should make you lean forward. Even with those premiums, stockpiles in the visible Chinese warehouse system have been trending down. The latest figure floating around has inventories under 40 million ounces, which sounds like a lot until you remember how fast industrial demand can chew through supply when it's spread across an entire economy. So ask yourself, if a market is paying up and still drawing down inventory, what happens when the next demand wave hits? That's your first cliffhanger. Now, here's where this gets personal. A lot of you don't measure wealth in charts. You measure it in life goals: a home, a piece of land, a business, freedom. So let's talk about a ratio that matters: how many ounces of silver it takes to buy a median-priced home. When that number falls, it means silver is gaining purchasing power relative to housing, or housing is losing relative to silver, or both. And when you hit old historical zones, it's not trivia. It's a signal that the cycle is changing. Now, I'm not promising you that one asset must outperform forever. I'm saying pay attention to the ratios, because ratios reveal the truth that nominal prices hide. A stock index can look high in dollars but weak in gold. A home can look stable in dollars but cheap in silver. That's how you see regime shifts early. Now let's bring the conversation back to the pipes and valves of the metals market, because this is where the story gets spicy. We're seeing ongoing drawdowns in visible inventories. We're seeing registered categories shrink. We're seeing big bars move. And every time bars move from one place to another, the question is, why? Are they being shipped to meet industrial demand? Are they being pulled to satisfy investment flows? Are they being used for arbitrage, borrowing paper, converting to physical, selling into higher premium markets? That last one is the one people hate to discuss because it exposes the game. Paper markets can create metal exposure without metal. Physical markets don't care about exposure, they care about ounces. So when you start seeing signs that big pools of paper exposure are touching physical bars, it's worth paying attention. Because it means the paper world is leaning on the physical world to keep the illusion stable. And illusions get expensive when demand rises. Now, there's also the retail angle: coins, smaller products, and mint pricing. When retail products spike in premium, some people laugh and say, that's just collectors. Maybe, sometimes. But retail premium spikes also reflect bottlenecks: slow production, limited blanks, outdated systems, surges in demand. Either way, it's another confirmation that the physical side isn't as smooth as the paper side pretends. Here's the important point. You don't need every detail to be perfect to understand the direction. You just need to see the pattern. And the pattern is this: more pressure, more volatility, more repricing. Now, the legal story that started all this matters because it changes the mood. If the perception grows that central banks are being squeezed politically, then every central bank globally gets a new problem. Because investors start questioning whether policy decisions are economic or political. And once that question enters the room, it doesn't leave quietly. It sits in the corner and watches every rate decision, every inflation print, every press conference. And when it doesn't like what it sees, it buys hard assets. Now, let's go deeper into the plumbing, the inventories and the flows. One of the most telling developments is the steady reduction in registered, deliverable silver in major Western vault systems. Depending on which update you're looking at, the drawdown since the physical premium wave accelerated has been on the scale of tens of millions of ounces, and some tracking suggests roughly 70+ million ounces have left the most deliverable category in a relatively short window. That matters because deliverable inventory is what the paper system leans on when challenged. When it shrinks, the paper market can still function, but it becomes more sensitive, more jumpy, more likely to gap when real demand spikes. Now, add India. India has been quietly doing something that should be front-page news in the metals world: massive inflows into local silver investment vehicles. We're talking about a single month seeing over 20 million ounces absorbed, and totals over a short period approaching 50 million ounces when you combine multiple products. Again, you don't need to worship the vehicles. You need to understand the signal. There is large, sustained demand for physical exposure, and it's happening in places that are already willing to pay premiums. That's your second cliffhanger. Because if those flows continue while visible inventories are already falling, the system has to ration demand the only way it knows how: with price. Now, another detail from the plumbing that people argue about. Large paper silver funds and trusts sometimes show changes in bar lists and vault reporting that hint at stress. When you see sudden drops in certain bar categories, and at the same time you see lease rates spiking in key hubs, the suspicion is that metal is being borrowed and moved to where it earns the highest premium. I'm not accusing anyone of anything here. I'm pointing out the incentive structure. If you can borrow metal cheap, create exposure in paper, and deliver bars into a market paying a fat premium, you've built an arbitrage machine. And arbitrage machines only run smoothly until the physical market says, no. That's why lease rates matter. They're the interest rate of physical scarcity. When they climb, it's the market charging you rent for being short real metal. Now, retail. Even if you never buy government-minted coins, the pricing there can tell you a story. When official retail prices jump to levels that feel absurd, like paying well over spot, sometimes dramatically over spot, it's not proof of anything by itself. But it is a sign that the pipeline between raw metal and finished product is strained. And strain matters in a market where sentiment can flip in a day. Now, let me ask you something that most people won't. If silver is already flirting with $100 in multiple regions, if global premiums remain sticky, if inventories are not rebuilding, and if the trust in institutions continues to fray, what's the catalyst that stops this? Is it suddenly massive new mine supply? That takes years. Is it industrial demand collapsing? That would require a real economic shock, and ironically, that shock could also push investors toward metals. Is it a policy miracle that restores credibility overnight? That's rare. So the base case, the boring case, is continuation with violent pullbacks. And violent pullbacks are exactly what shake out weak hands and transfer metal from impatient people to patient people. Now, I want to put a bow on this section with a practical mini framework. If you're allocating, think in tranches, not all-in bets. Think in time, not tweets, and keep liquidity for volatility, because the next move won't announce itself politely. Now, I'm going to say something that will make some people mad. A lot of top callers aren't analyzing silver. They're analyzing their own discomfort. They see price move, they feel fear, and they turn it into a confident prediction so they can feel in control. But markets don't care about your comfort. Markets care about flows, constraints, and incentives. So if you're watching a currency like the Swiss franc, the so-called safe haven, start losing purchasing power against silver, you should pause. Because that tells you this isn't just an American story. It's a fiat story. And the yen carry trade, same idea. When global liquidity shifts, it doesn't ask permission. Now, I want to build retention with you by doing something simple. I'm going to walk you through a scenario that sounds crazy, right until it doesn't. Imagine the next 12 months deliver a continued loss of purchasing power in major currencies, but stock indexes stay okay nominally because liquidity keeps them afloat. Most people will look at stocks and think, see, everything is fine. But if gold keeps outperforming, that fine is an illusion because the unit of account is degrading. Now add one more ingredient, a shock in industrial demand, or a fresh wave of investor fear, or a geopolitical escalation that makes supply chains worse. What happens to silver in that environment? It doesn't crawl higher, it jumps. And when it jumps, the commentary changes. The same people who told you it was a bubble start telling you it's a new normal. And by the time they say that, you already missed the easy part. This is why you're here, to not miss it. Now, quick reminder, while you're watching this, there's already a members-only video published that consolidates the most important updates in one place, plus deeper analysis for premium members. If you want the full picture without me holding back, join the membership. It's also the cleanest way for me to know who's actually following closely. All right, let's get into what the market is showing right now. Gold has been pushing to fresh nominal highs, and the way it's behaving matters. When an asset breaks out and holds, it's not the same as an asset that spikes and collapses. Holding strength in your highs is a message. Sellers aren't overwhelming buyers. And when that happens while trust is wobbling in institutions, you should assume more people are quietly allocating. Silver is even more dramatic. Silver doesn't politely appreciate. Silver compresses, frustrates, gets written off, and then it moves so fast people think it's manipulated, even when it's simply catching up to reality. Now, do I expect volatility? Yes. Do I expect pullbacks that scare people? Yes. Do I expect mainstream narratives to call the top 5 times before the real top? Also yes. But none of that changes the setup. Now, let's address the global physical story, because it's easy to get lost in headlines. We're seeing strong demand in key regions that are willing to pay premiums. We're seeing visible stockpiles decline. We're seeing flows into vehicles that claim to hold metal. And this is where I want you to think like a detective, not a fan. When huge amounts of metal appear to move into one place, ask, is it new supply, or is it metal being pulled from somewhere else? Because if it's being pulled from somewhere else, you didn't solve scarcity, you just moved it. And moving scarcity around the globe is what happens before price resets. Now, one of the most powerful ways to understand how brutal this move has been is to remember what $100 used to mean. A $100 bill used to feel like a lot. It used to buy real things. Now it struggles to buy an ounce of silver in many places, and in some markets it's already effectively lost that fight. That's not a silver story. That's a currency story. And currency stories don't end with a polite press release. They end with repricing. Now, I'm going to add a layer that a lot of viewers want me to address: critical metals and national policy. We're seeing governments openly admit they import too much of what they need. That's a vulnerability. And when governments admit vulnerability, they do one of two things. They either pay up to secure supply, or they try to change the rules to control supply. Either way, the price signal strengthens. Because a world that is racing to secure commodities is a world that is willing to pay more for them. And a world that is willing to pay more is a world where the old price averages become irrelevant. Now let me pause and do something important for community. If you're watching and you've had a win, in metals, in business, in investing, in anything, share it in the comments. Not to brag, to help. Because seeing real people succeed raises the floor for everyone else's confidence. And while you're down there, here are 2 questions I want you to answer. First, do you think this legal pressure storyline ends quietly, or do you think it escalates into a broader confidence crisis? Second, if silver hits and holds triple digits this year, what do you think will surprise people most? The speed of the move, or the way the media changes its narrative overnight? Drop your answers below. I read them, and they shape what I cover next. Now, let's talk about the debasement trade, because that phrase sounds dramatic until you realize it's just math. When governments spend more than they collect, and central banks expand balance sheets, and economies rely on perpetual credit, the currency unit trends downward in real purchasing power, sometimes slowly, sometimes in bursts, but over long horizons the direction is obvious. The reason gold and silver matter is that they're the scoreboard you can't edit. You can change CPI baskets, you can change definitions, you can change narratives. You can't print ounces. So when the metals are signaling stress, it's worth listening. Now, people ask, how high can this go? I'm not here to throw outrageous targets just for clicks, but I will tell you this. In a regime change, historical ceilings become floors. That's what everyone learns too late. And you can see it in the way old levels that held for decades get chewed through once the market decides the currency is the problem. Now, another factor you should watch is the relationship between gold and silver, the ratio. When that ratio compresses, it means silver is outperforming gold. And silver tends to outperform gold when the market is moving from fear into scarcity, from safe haven into real-world demand. So when you see the ratio dropping, it's not just a trivia fact. It's the market telling you the move is broadening. Now, let's address a major objection people have. They say, but what if this is all paper hype? What if it reverses? Here's my answer. It can reverse in the short term. It can't reverse the structural setup overnight. If the world has underinvested in supply for a decade, you don't fix that with a tweet. If industrial demand is rising because of energy transitions and technology, you don't cancel that with one policy speech. If currencies are being debased globally, you don't repair that with one good month of data. So yes, pullbacks happen. But the reason pullbacks become buy opportunities in secular trends is because the drivers are still there when the chart looks scary. Now, I want to give you a cliffhanger you should hold in your mind. The next phase of this market may not be driven by retail demand. It may be driven by institutions that have ignored metals for years, suddenly allocating because they're forced to. And if that happens, the price behavior changes again. Because institutional flows are not patient. They don't buy one coin. They buy positions. And when they buy positions in a market with limited physical supply, you get gaps. Now, let's talk about how the narrative evolves. Right now, the mainstream tone is still mixed. Some are excited, some are skeptical, some are warning of pullbacks. But watch what happens when the safe haven trade becomes the performance trade. When gold and silver aren't just protection, they're among the best performing assets. That's when the late money arrives. And late money doesn't arrive gently. It arrives in a rush. Now, a practical note, because I know some of you are new. If you're buying physical, be mindful of premiums and liquidity. If you're using vehicles that claim metal exposure, understand what you actually own. And if you're allocating in any form, keep your time horizon aligned with the trend, not the daily noise. Now, I want to circle back to the legal story one more time because it's the spark. Even if you believe the legal action is justified, the market doesn't care about your moral stance. The market cares about consequences. And the consequence of public conflict between law enforcement and monetary authority is uncertainty. Uncertainty pushes people toward what they can't dilute. So whether you think this is politics, accountability, or theater, the market reaction can be the same. More demand for hard assets. Now, I want to layer in something else that's quietly happening. When certain countries pay persistent premiums for physical metal, they pull supply away from places that used to feel well stocked. And when that happens, inventories in familiar places decline. That decline becomes a story. That story becomes fear. And that fear becomes demand. It's a loop. And loops in markets don't stop because someone on TV says, calm down. They stop when supply rises, demand collapses, or price moves high enough to force a reset. Now, here's another cliffhanger. If you think triple-digit silver is the climax, you're thinking too small. Triple-digit silver is the headline that wakes up the crowd. The real story is what comes after the crowd wakes up. Because once people accept that $100 doesn't buy what it used to, they start asking, what will $100 buy next year? And that question is contagious. Now, we need to talk about how you can support this channel while staying informed. Subscribe if you haven't. It's free, and it's the easiest way to help. Join the WhatsApp channel for the fast updates. And if you want the full consolidated breakdowns, join the membership and watch the members-only video that's already up. Also, one more time, if you've had success, share it in the comments. You'd be surprised how many people need to hear that someone like them made a smart move and benefited. Now, let's walk through the week's market behavior like a storyteller, not a spreadsheet. We started with institutional stress. We watched currencies keep bleeding purchasing power. We saw metals hold strength and push higher. We saw ratios shift in ways that favor silver. We saw physical signals, premiums, drawdowns, movement of bars. We saw retail bottlenecks show up in pricing. And through it all, the central theme stayed the same. The debasement trade is not done. Now, where does this go? If the next few months bring more pressure on central banks, more political heat, more geopolitical tension, and continued resource competition, then the bid under hard assets stays strong. If on top of that, we get any economic wobble that forces rate cuts or renewed liquidity, you may see the next leg accelerate. And here's the twist. Rate cuts that were once good news could be interpreted as currency dilution in this environment, which again supports metals. So don't assume old correlations hold. Regime change means correlations break. Now, let me give you a simple mental model. In the old world, people trusted institutions, so they chased growth assets and only bought gold in panic. In the new world, people question institutions, so they buy gold and silver as baseline protection, and then they chase performance on top. That subtle shift changes everything. It turns metals from insurance into allocation. And when that happens at scale, the market has to reprice to ration demand. Now, I want to close by pulling you into the next episode of this story, because the biggest moves often happen when nobody is watching. They happen in the gaps between headlines. They happen when one region quietly drains supply. They happen when one large buyer decides they're done waiting. And then, one morning, the price is simply higher, and everyone pretends they saw it coming. So here's what I want you to do. Watch the ratios, watch the premiums, watch the headlines for pressure on monetary policy. And most of all, watch your own psychology, because the market will test you with volatility before it rewards you with trend. If you made it this far, you're already ahead of most people. Now hit subscribe, join the WhatsApp channel in the description, and if you want the full deep dive, become a member and watch the members only update that's already live. And don't forget, comment OG John AG if you want to support the campaign against copycats and keep original analysis alive on this platform. I'll see you in the next video. Thanks.